environment, where are you going to put your stop? Being unable to define the stop on the trade can interfere with your risk profile for your trading plan. Now keep in mind that a simple breach of either extreme does not invalidate the range, as the range could simply be expanding to a larger size. This is quite different than erratic swings in each direction, and while it may turn into an erratic expansion, at this point we can still find positions. Now a converging range. Well, there are different names for each chart pattern. I just keep it simple, and if the market's not in a trending state, I just call it a range-bound market. This is the opposite of the expanding range, and here price appears to zero in on a particular price point. Compression is occurring, and generally a trader will look to position themselves in the breakout of the move when it occurs. Noting there's compression is important because when it breaks, there could be a strong move behind it. Now, given that, looking to fade breaks of these types of compression ranges, it's probably not a wise trading plan. So why does range trading work? Well, we covered a few things to look for when trading ranges, including not assuming the range will hold and looking for a sign that a fade of the range extreme is the right play. You also noted that a range can take various forms, and some are easier to get a handle on than others. Seeing a market in an expanding range would probably take that market off my list of tradable instruments. The converging range would have a breakout play in mind, and while some will still fade the extremes, it doesn't suit my plan. Now, I don't actually know of anybody who trades inside the converging range. Now, while there may be some looking to position in a breakout in the direction price was headed prior to the range, it seems to be the most common play. So let's cover why range trading works as a viable trading method. Now, once a range is formed and you've determined where the extreme zones are, you now know exactly where you're looking for a trading opportunity. There's no guesswork involved. Price will either break out of the extremes, reverse at the extremes, or expand at the extremes. Now, the middle of the range, probably not an area you want to play in. Support and resistance levels. Now remember, you're looking for obvious ones. They make up the extremes of the range, and support and resistance are zones that garner a lot of trader interest. You will have some type of action around these levels that can range from a clean test of the level to price just whipping around the zone. The key is to have a trading strategy that sets up what you're looking for and how you're going to trade it. What type of price rejection are you looking for? Where are you going to place your stop? Will you use other tools to help in your decision? Just remember that ranges end and a trend will begin. Before that happens, taking trades while in a trading range can offer up another opportunity for those looking to make money in the markets. Now, trading indicators, they can aid in your decision, and when trading ranges, oscillators can have a place as part of a trading plan. Let's look at the slow stochastic trading indicator as a tool that you can use when looking to trade the extremes of the range. The extremes are marked by the circles, but you can see later that the top gets exceeded in a breakout failure type of action. At A, price pushes into the extremes and sets up a reversal candle. The indicator plots into the overbought area. It's not a signal by itself, and you have a shift in momentum, which is shown by the cross of the indicator lines. It's a combination of each event that may or may not constitute a trade. Price drops to the lower extreme at B, and you get an engulfing pattern, an oversold indicator, plus a momentum line cross. Now, was C close enough to the new extreme put in at A? Is there a reversal type of candle pattern? Is there a slowing down of momentum seen in price? Besides the indicator position, I don't see much enticing with this trade, especially since price action did not show any sign of a potential reversal. Now finally at D, price pushes to the new extreme, shows weakness while the indicator is overbought, and you see a momentum line cross. The indicator is part of an overall range trading plan and should not be the only variable that you use for making a trading decision. So let's wrap this up. Simple still works in trading, and the key is discipline and consistency. Without those, any type of success will be short-lived regardless of the merits of your trading system. And as you head into trading strategy, keep in mind everything you've covered up to here. We're going to find our trading range. Trading ranges are formed with support and resistance zones. You can look for current ranges or find trending markets that are starting to slow down. Ranges turn to trends, trends turn to ranges. I also consider pullbacks a range in the general sense, but those are not going to be covered here. This chart has an uptrend in play and then price started to pull back. The high is marked off, and once the pivot low is in place, that's marked as well. For the trend to continue, you need to see a higher high. If that does not develop, you can start thinking of a range play. The chart shows that price didn't advance into a trend continuation after the low, as you put in a lower high marked X, but failed to make a lower low. Now I chose a not so perfect example of a range as showing a perfection trade. It's always easy to do. Now location and price. With the extremes of the range marked off, you now have areas where you can monitor what price does and if you have a trading opportunity. In our example chart, the yellow highlights areas of interest. Number 1, price revisits the low, indicators oversold, momentum line cross, inside bar candlestick. Number 2, highs tested, consolidation below the extreme calls for caution. Candlestick starts showing a lack of momentum and an inside pattern. Indicator oversold and the cross. Number 3, price fails before an extreme test. Indicator not in the overbought zone, good reversal pattern, but no trade. The indicator is in the middle zone here, number 4, bearish momentum cross, no reversal pattern, price breaks through the extreme. So we need a price to make an attempt at the extremes. When that condition was met, we wanted to see an oversold, overbought indicator position. A bullish, bearish momentum cross helped build our case for a trade, and then we needed to see a reversal pattern in the price action. So placing your stop, you would think that placing your stop just outside the extreme would make sense. After all, you often read that you should place a stop where you would be proven wrong. The problem is that you can have the extreme broken and the trade and the range is still valid. Think back to the expanded range chart and you can see that the range play is still a valid trading opportunity. The range still exists, but with different extremes. There's a pattern called a failure test that needs to break an extreme and can take you out of your current trade when you should actually be getting into a trade. Now, what about a distance away from the extreme? Well, how far is enough? Given that most people base their position size on their stop loss, this could lead to a very small position or, depending on the market and your capital, no trade. Inside the range? Well, thinking back about where the majority of people put their stops, the textbooks, where do stop runs usually go? Now, if you know that most traders use either the extreme or a little bit beyond, those that can run the stops know that as well. Depending on the market and trading volume, a stop run could have traders exiting at prices beyond their stop due to slippage. Stop orders, once triggered, turn to market orders to be filled at the best possible price and can equal slippage. Now, if you were to short from the extremes and your stop is placed just outside the extreme, you'd be taken out before the trade is able to mature. If stopped out, this trade may have had slippage, giving you a worse risk profile than you had planned for. If the price is going to come close to the extremes, it's probably going to test the extreme and slightly beyond. A stop just inside the extreme will have you out of the market before the stop runs trigger. The fact is there's no perfect location for your stop and that's going to allow an optimum position size. Thinking of yourself as a risk manager will aid you in your stop placement decision. So our blueprint, how you end up trading ranges is going to depend a lot on the type of trader you want to be. There are a few important variables to pay attention to. However, it can be simply summed up with find the extremes of the trading range, look for signs of reversals, take a position, manage it. Now, whether you range trade Forex or futures or any other market, the basics that we just covered, they apply. Take your time, test it, develop your trading plan, and be consistent with how you've chosen to trade.